some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's stiff.
Are you ready to tap into the untapped potential of emerging markets? Discover how top investors navigated political instability, currency risks, and market illiquidity to secure massive returns. Don't miss out on the insider strategies that could change your investment game forever. Institutional gaps. In emerging markets, investors often face a lack of key intermediaries. Take India, for example. While the country's economy is booming, it lacks certain structures like efficient credit systems and market research firms, which are standard in developed countries. This creates gaps that savvy investors must navigate. Mark Zuckerberg, founder of Facebook, once faced these gaps when expanding his company into India. The lack of reliable data and intermediaries made it difficult to forecast market trends accurately. But by understanding the local environment and collaborating with local businesses, he successfully expanded Facebook in Asia. Emerging markets, like those in Africa and Latin America, face similar issues. Nigeria, with its growing population, offers great potential but lacks sufficient market research tools. Investors who succeed there do so by learning the local practices and filling in those gaps themselves. Navigating these voids requires patience and local expertise. Just like Zuckerberg, understanding the environment, rather than relying on traditional methods, is key to success in these emerging markets. Diversification. When investing in emerging markets, diversification is a vital strategy. Take the example of Elon Musk, who invested in various sectors across China and South Africa. He didn't just focus on one industry or one country, and that spread out his risks. In Brazil, the market offers opportunities in agriculture and technology. But one major risk lies in the country's reliance on commodities like oil and iron ore. Diversifying across sectors, such as tech and energy, shields investors from the impact of commodity price drops. This strategy, used by investors like Musk, ensures a balanced approach. Africa presents a different set of opportunities. Countries like Kenya and Nigeria are leading in fintech. Jack Ma, founder of Alibaba, successfully invested in Kenya's tech sector, showing how broad diversification across multiple sectors can provide profitable growth. For successful emerging market investments, spreading your assets across countries and industries allows you to manage risks while taking advantage of growth in various sectors. Just like Musk and Ma, you need to balance your portfolio. Political stability. In emerging markets, political stability plays a critical role in determining investment success. Vladimir Putin's leadership in Russia offers a prime example. Investors in the early 2000s were attracted to Russia's oil sector, but political uncertainty under his reign led to abrupt policy changes, shaking investor confidence. Nigeria is another case where political instability has affected market growth. Despite its large population and rich natural resources, the country's frequent leadership changes and corruption issues deterred foreign investors. However, local investors who understood the system and adapted to the volatile political environment managed to thrive by closely monitoring governmental shifts. George Soros, the famous investor, navigated these risks when he invested in Eastern Europe during the 1990s. His deep understanding of the region's political shifts allowed him to make timely investments, earning huge returns as countries like Poland and Hungary moved toward democracy. In emerging markets, understanding and monitoring the political environment is crucial. Soros' strategy of political insight paid off, proving that staying informed can lead to significant gains. Currency risk. Currency fluctuations are a significant risk in emerging markets. Warren Buffett, in his early investments in Brazil, faced issues with real currency volatility. The Brazilian real weakened dramatically, leading to significant losses for foreign investors. However, Buffett's investment in local businesses helped mitigate some of the currency risks as he had local revenue streams. In Argentina, the peso devalued sharply in 2018, causing a major hit to many foreign investors. But those who understood the impact of currency fluctuations, such as Paul Singer, a hedge fund manager, protected their investments by hedging against the currency risk and adjusting their portfolios. For countries like Turkey, where the lira has experienced high inflation and devaluation, investing in companies with strong international operations or assets in stable currencies offers a safer route. As Buffett showed, understanding currency risks and hedging properly can be key to protecting your investments in emerging markets. Currency movements are unpredictable, but being prepared can turn potential losses into long-term gains. Experienced fund managers. Investing in emerging markets requires expertise, and that's where experienced fund managers come into play. Take Ray Dalio, the founder of Bridgewater Associates, whose deep knowledge of China's economy helped him navigate its complexities. In the early 2000s, Dalio made significant investments in China's financial markets, understanding that local expertise and experience were crucial. Similarly, when Abigail Johnson, CEO of Fidelity Investments, expanded the company's portfolio to include emerging market funds, she relied on local fund managers who understood the nuances of these markets. Their local knowledge allowed Fidelity to invest in areas like India's tech sector and Africa's mobile industry, which outperformed many developed markets. Experienced fund managers understand the local risks, regulatory environments, and cultural factors, providing valuable insights for global investors. By trusting in the knowledge and skills of these experts, investors like Dalio and Johnson have found success in markets that others might consider too risky. If you're looking to invest in emerging markets, partnering with an experienced fund manager can make all the difference in navigating these complex landscapes. Long-term focus. Investing in emerging markets requires a long-term horizon. Jeff Bezos, when expanding Amazon into India, knew that success would not come overnight. Despite the challenges of regulatory barriers and slow infrastructure development, he held his vision for the future. In the long run, his patience paid off as Amazon India became one of the leading e-commerce platforms. Similarly, Mark Cuban invested early in China's tech sector, where growth potential was high, but the market was still evolving. He understood that the sector would take years to mature, and his focus on long-term gains helped him weather the short-term volatility. In Vietnam, despite the risks of market inefficiency and unpredictable regulations, investors who took a long-term view found success. The country's rapid development in recent years has rewarded those who remained patient and invested with a future mindset. By adopting a long-term focus, like Bezos and Cuban, investors can ride out the market's fluctuations and ultimately benefit from the exponential growth that emerging markets promise. Regulatory changes. In emerging markets, regulatory changes can have a significant impact on investment outcomes. Jack Ma, founder of Alibaba, faced the challenge of changing regulations in China. In 2020, China's crackdown on tech giants led to tighter regulations that impacted Alibaba's stock. However, Ma had navigated similar regulatory shifts in the past, and his business remained resilient due to strategic adjustments and local partnerships. In India, the government's shifting stance on foreign investment regulations created a turbulent landscape for investors. Yet, firms like Reliance Industries, led by Mukesh Ambani, adapted by aligning their operations with evolving rules, which protected them from regulatory risks. Ambani's understanding of India's regulatory framework allowed his business to thrive despite policy changes. For investors in Mexico, understanding trade agreement shifts, such as those under NAFTA, now USMCA, has proven essential. Carlos Slim, one of the richest men in the world, capitalized on these changes to grow his telecom empire. By staying informed and flexible, investors can turn regulatory changes from a challenge into an opportunity, just as Ma, Ambani, and Slim did in their respective markets. Market illiquidity. Investing in emerging markets often means dealing with market illiquidity. Richard Branson, when expanding his business ventures into Vietnam, faced challenges in buying and selling assets quickly. Due to the country's less developed financial markets, liquidity was low, making it difficult for investors to enter or exit positions without affecting prices. In Nigeria, investors often encounter difficulties when trying to liquidate assets quickly. The stock market in Nigeria is less active, and transactions may take longer to complete. However, those who focus on long-term growth, like Aliko Dangote, the wealthiest person in Africa, have been able to navigate these liquidity issues successfully by securing solid, long-term investments in industries such as cement production and oil. Similarly, in Russia, where the market can be volatile and illiquid, investors like Mikhail Prokhorov have faced challenges with quickly moving their assets. But by focusing on the country's long-term potential, such investors have been able to grow their wealth despite the lack of liquidity. While market illiquidity can be an obstacle, understanding the market's nuances and taking a long-term approach, as Branston, Dangote, and Prokhorov did, can help investors succeed.